What's up, everybody? Ryan here. Today in this video, I'm going to be walking us through the three lenses of business valuations so that way you can answer the question, what's my company worth to me? What's it worth to any buyer in the marketplace? And what would it be worth to one specific buyer? And how does it impact my goals? And so before I jump into the overview of each of these, and then I'll have a separate video for all three of them, I want to just quickly orient us. So all of this material is based on my Independence by Design owner's playbook that I created on how to move from operator to owner so you can run the company from the boardroom. And why I think we're all doing this is because the word independence. I think everybody that I know that I work with that owns a company wants to be able to have the option to own the company, step back, scale, or sell without impacting their goals of independence. And so we're trying to create a lens to analyze how do I make decisions so that way I can always be aligned with my goal of having independence and having that forward momentum to my goals and that alignment. And it's based on this Independence Flywheel core philosophy, which I believe that the entire point is independence escape velocity. And this flywheel, you can go check out a little bit more of it in the introduction. But the goal is that we're taking our time that we're spending every day and we're using that time to generate cash flow through work. And so that work is generating cash flow, usually in the form of W-2 and distributions. And we're taking that cash flow and we're investing that cash flow into wealth generating assets like our company or outside investments. And that's that constant trade off of, do I reinvest? Do I take distributions for my lifestyle, or do I reinvest outside of the company into other assets? And the point of wealth generating assets is that we create income that frees up our time. And so these are the theory. It's the theory of constraints, so that we're constantly opening up the bottleneck and we're staying aligned with more time, more cash flow, more wealth. And every single decision and all of the effort that we're spending and investing of time and capital is going to get us more independence. And it's based on the framework, which you can go check out the introduction video that explains this entire framework. But the whole goal is that we're decoupling our cash flow from our time, and then we're building wealth, and we're creating this escape velocity by working on the most important things at the same time, or the most important thing that's going to open up that bottleneck. And we're making trade-offs of time, cash flow, wealth, so we can create independence and scale the company, step back, sell the company, do whatever we want. But we're running the company from the boardroom and we're becoming a capital allocator. And today we are going to be diving into the expand knowledge module. And the reason that we start with the expand knowledge module is because we need to understand the game of ownership. In order to make sure that our time and our money that we're investing back into the company is providing a return of more cash flow and equity, we have to understand how valuations work. And after a decade doing this and having 3,000 people through my workshops and having, three different companies and hundreds of companies' financials that I've worked with, the lack of understanding of business valuations, I think, is the key root problems behind people just floundering around, because we are just guessing most of the time. And that's what I'm trying to demystify with these three lenses of the business valuation. So that way, as you're making decisions, you have an idea of what's the ripple effect. Am I going to stay aligned with my momentum towards independence or not? And so what we're going to walk through in this video is just a quick overview of the three lenses, why they're important, why I created them, and how I and my coaching clients use them as a lens for making decisions. And it all starts with this question of, like, what's my company worth? We have so many different routes we could go with our decision making. And if we don't know what our company's worth or how valuations work, we're just guessing. And so by understanding what's the ripple effect based on our goals, we have way more choices to actually stay aligned with our goals. And my favorite, not my favorite, but like one of the most ridiculous highlights of this is I had this excavation company I worked with, about 10 million bucks. And he's like, yeah, I've been doing this for 10 years and I have no idea if what I'm doing every day is growing value or not, or if I'll generate more cash flow. But the challenge with that question is the moment that you ask, what's my company worth? The blood is in the water. The advisors come out and again, there's always going to be a point for these advisors. There's really good people out there, but the entire system is aligned towards getting deals done because that's where money's flowing. So there's transaction fees, there's advisor fees, there's the buyers want a good deal. And so the friction in the marketplace for the owners that ask this question is that you don't want to sell necessarily. And most often you don't want to. I just want to know, what the hell is my company worth and how do valuations work so I can make better decisions. And everybody in your peer group has different opinions on how valuations work. They're talking about a revenue, multiple revenue because they're a SaaS company, but you're a manufacturer, professional services. You have family members that want your time back and they're sick of you spending too much time in the business. So they maybe want you to sell, or they maybe want a liquidity. Your employees need you to keep the company. Your CPA is looking for quality of earnings and audits. And your banker is going to want to keep lending you money. The moment you say, hey, I think I might want to sell, they all of a sudden look at a risk for you and their loan portfolio. Your CFO, if you've got one, should be your co-pilot. But so many times, most people don't have a CFO, so they don't have the correct visibility. Investment bankers and brokers absolutely want to sell the company unless you find a good one who might be willing to spend some time to give you advice years in advance. But they're incentivized to sell the business, and that's how they make money. Attorneys want to bill hours. So it's your M&A attorney, your estate attorney, your corporate, your legal counsel. They're looking for, billable rates. Your wealth manager wants an asset under management. They want liquidity because 98% of the wealth managers out there don't have a business model that allows them to charge on illiquid assets, which, by the way, provide the highest return these days. And then consultants, there's going to be the exit planners. I mean, that's every consultant I've worked with or I've seen over the years, they've relabeled themselves as an exit planner because they're going to be able to collect more fees driving towards a transaction. Huge generalization here, but it's the general truth. And just being aware that this is the situation and everyone's out for a deal is going to help. It makes it so difficult as an owner to say, okay, I just want to know what the hell my company's worth and I don't want to sell. And how do I actually make better decisions? I think it's so similar to the healthcare system where years ago, I swallowed the golf ball of reality that most doctors are insurance salespeople. They're not sitting there going, hey, are you sleeping well? Are you eating well? How's your stress? How's your diet? Are you exercising? There's no way to monetize that situation. Yes, all those specialists are important, but we need to know when and how to use them. And by understanding business valuations, we have more power ourselves and more self-control over the outcome to make sure that we're making the right decisions. Then we go right to the advisor, say, here's what I'm looking for, and here's why, and here's what I think I'm trying to do. Now give me the last two final ideas. The same applies to AI, by the way. The more we understand our goals and the more we understand this material, the better we can use AI, the better we can use our advisors around us. The implications of not understanding business valuations is up here is where you are right now. And you're making all those decisions. You have all these decisions of, should I launch a new product or service? I don't know. So all of a sudden you go, if you're trying to go from Minnesota, which is where I live, to Florida, you're going all over the place and you don't know what's the timeline, what's the budget. Do I have the time to spend and take a pit stop? Do I launch a new product or service? How is that going to impact my cash flow and my wealth and my net worth and the value? If I want to step back from the day-to-day and hire a CEO, how does that impact my cash flow needs? If I sell the business, who do I sell it to? What are the different types of buyers? How does that impact my wealth and my cash flow? Do I buy a company? Well, if you buy a bunch of companies, you might be accumulating a bunch of debt and then you don't have enough money for cash flow and then you might have to sell. All of those, if they're pegged to revenue, which I had a $21 million business and it was like revenue, optimized gross profits. Hopefully, net income has no correlation to cash, and hopefully there will be enough cash in our bank account for a good K1. We're going to flip that switch and take the ownership red pill to say, I want to understand business valuations and the three lenses and how I make decisions. So that way, if I go and make decisions, I'm staying aligned from my goal all the way to, where I'm at to all the way to my goal. So if we say in 2030, I want a $10 million net worth, but I need to maintain a $250,000 income along the way. The only reason we should launch a new product or step back from the day-to-day or buy a company or sell the company is because it's going to get us closer to our goal. If it doesn't, don't do it. And that's the level of clarity I want for you, is because the only way we get that clarity is if we understand how valuations work, how reinvesting can generate more cash flow or not. Because the way that money works is we either take more money today, but we're suffocating our growth, our net worth, or our equity for tomorrow. But if we invest our money, we should have more equity tomorrow. It's the whole definition of sweat equity. If you're here, you probably put in years of hard work, probably not paying yourself as much as you should in the hopes of growing value. Let's eliminate that hope and make it a little bit more mathematical and more predictable. So here is where I want to introduce the three lenses of business valuations. The way that we're going to use these lenses is we're going to stack them on top of each other, so that way as we make decisions and as the questions or the situations that we are coming across are becoming more clear, we get to actually say, okay, well, what's it worth? So what's it worth to me, which is the owner's utility lens? What's the market? What's the valuation to the market based on the 4 KPIs that are knowable no matter what buyer's out there? ESOP, private equity, management buyout, third-party sale. There's 4 KPIs that are the general KPIs that we can measure, monitor whether we're selling the company or not. So we always have a gauge on like, okay, here's what the company's worth to me. Here's what the company's worth to any buyer. And then the last one is a specific buyer. Buyer, which comes with a specific deal structure and a whole bunch of nuances. And through using these 3 lenses, we can always make sure that we have options. If we are focusing on growing the value of the company while we own it, we are making sure that we're investing our time and our capital into things that grow the equity value of our company while managing the trade-offs of our cash flow that we need or want. So what I'm going to do quickly is just go over each lens, so that way you have an introduction to it, and then there will be a different video where I am going to walk through in great detail how each of these work, all of the nuance and mechanics behind it. One thing that I've struggled with over the years is this gets technical, and I want you to know how the technical things work. And part of my desire for putting these videos out is with health, and I go back to there's such a good parallel with health, is that I had to go through and like watch hours of Andrew Huberman or Peter Attia or all these doctors to better understand how the body works so I can make better decisions. And I'm watching the popularity of those, the people I just mentioned, go into the millions of followers is because people are just thirsty for real information that's not coming with I gotcha. And that's what I'm trying to do here is like, you're watching this, whether you're working with me or not, you can take this information and hopefully your life and your decisions are better from it. So I'm going to first start with the owner's utility lens. And the owner's utility lens, if you were to take that flywheel, the time, cash flow, and wealth, and we double click it and we actually get and expand and say, okay, what does that actually mean to me? Well, the way that our life works is we have time that we're spending in the business. So that time is going to come with a W-2 salary, which is our job. And that W-2 salary right here, whether you're paying yourself market wage or not, you actually are getting a salary from the job that you're spending in the business. And the people that are working on the Independence by Design Owners Framework, they're trying to reduce that salary over time. Either reduce it and the way that we can maintain our income is because we are going to continue to maintain that income through collecting our salary through distributions. So distributions, and I will get into that into more detail in the owner's utility lens video, that is the ability to see into the future when and how you get your free cash flow distributions after working capital, payables, receivables, inventory, taxes, debt payments, reinvestment. And then what's left after that, you can take money out of the company without suffocating the growth towards the equity valuation, which is your wealth. So then what we have to better understand is then what's the trade-offs and how do the business valuations work? And inside the owner's utility lens, we're going to be talking about the discounted cash flow, which is the risk of that future cash flow of your distributions. So the way that I've got this broken down, and I'm just introducing this concept right now. We're going to go into how the valuations and how the cash flow and the equity valuation work in Lens 1. But in the Clarify Goals module, which is the second module of the framework, we're going to be talking about clarifying your actual goals of time, cash flow, and wealth. So how much time do you want to spend as an operator? now, what are you doing right now? And what do you want that to be? If you want your cash flow to go from 200 grand to 400 grand, but you want that to shift into more of the distribution box, when and how do we do that? What's the trade-offs? Because if you can design a company where you're sitting in the boardroom and you're not sucked up in the operations and you're collecting 400 grand in free cash flow, it's a really good investment. And by having that predictable cash flow, you're actually growing the equity valuation of your business via the discounted cash flow up here. So I know that's probably a mouthful for everybody, and that's why I'm going to be breaking it all down. But what we want to do is see what's the trade-off if you want to go from $5 million to $10 million in net worth. And then what's the best way in your wealth portfolio? Is the business the best investment, or is an outside investment like stocks, bonds, Bitcoin, real estate, something else that might get a higher return? But you're just making that decision based on your goals, making sure I don't run out of cash because I've got certain lifestyle needs. And then I'm trying to figure out where do I reinvest that cash into my net worth to make sure that I'm always going to be on track towards that flywheel of independence where I'm free. I can do whatever I want, whether I own the company or not. The second lens is what I call the market valuation lens. And the market valuation lens is a great lens because what we can do is track and monitor 4 KPIs in the financials while we own the company, regardless of whether we want to sell or not. So the quick overview is, first we have normalized EBITDA. And what normalized EBITDA is, it's a proxy, just a proxy for that cash flow, for that normal level of cash flow, regardless of who owns it. So it's a normal, what's the normal level of cash flow? And there's an exercise that I'm going to be introducing in this video of the market valuation on normalized EBITDA, where you're going from net income to EBITDA to normalized EBITDA, and what are the different examples. And then we can go and what we can do is we can then take that and multiply it by a number called the multiple. And the multiple is the proxy for the number of years of cash flow based on the risk of that future cash flow. If you hear in your industry, if you're professional services, it might be from 3 to 6. If you're in SaaS, it might be from 8 to 10. If you got a hot market, it might be from 8 to 11, or it might be just 3 to 5. I mean, the size of the market and your industry, there's a lot of different data points out there from, your industry association, business brokers. There's a study out there called Pepperdine Capital Markets. I've had the director, Craig, on the podcast, and they come up with ranges and they say, hey, in this range, in this industry, and this size, here's the range. Well, we can track the normalized EBITDA and we can track a range of multiples and say, hey, I think my normalized EBITDA in 2026 is going to be 1.5 million bucks. The range is going to be 3 to 5. Where do I land? Maybe a 4. But we can know that while we sell without having to sell the company. Then when you sell a company, we have something called net debt, where you sell, it's what you owe lenders and what cash you have. So a company in the middle market is sold cash-free, debt-free. So like in 2009, had my father and I sold our business, we would have owed the bank money on a $21 million company. That is not worth it. We had the Inc. 5000 and all that other shit, but like, who cares if you have negative equity because you have too much debt? And the goal, and sometimes you could have actually more cash. You have like extra cash on the balance sheet that is yours. And that's why then the buyer, regardless of whether it's an ESOP, private equity firm, they're going to require a normal level of payables, receivables, and inventory that stays in the business. So reducing your working capital needs as a percentage of revenue is a great metric because it's money in your pocket. Because if you're collecting your receivables at 30 days on average instead of 60, you're going to have a lot more money in your bank account while you're running the company for distributions. You're going to be able to optimize your line of credit. And when you sell the business, that money will actually go into your bank account. And if you have excess cash, you can prove that the buyer doesn't need that. And this is applicable across all of the different types of buyers. And then that brings us into the third lens, which is the strategic transaction value. And the reason I am bringing, let me go back. I forgot to, so I'm going to go back and just explain how those 4 KPIs work together on a trade-off. So right here, we want to take cash in the business. So if we're actually going to be growing the value of the business, we want to take that cash and we want to reinvest that cash into growing the multiple and de-risking that cash flow. And if we grow that multiple, then we want to optimize working capital. And if we optimize working capital, then we can pay down debt or take on good amounts of debt. When I say good amounts, it's actually an effective use of capital, because if your company is providing a 20% rate of return, having even 8% debt is worth it. That's why private equity fully leverages companies. And then you have this choice of, what do I do with my cash? Do I take it out in the form of a distribution, or do I reinvest it back into growing the value of the company that generates more cash? So it should be this flywheel that is growing the value of the company and growing cash flow. And again, we want to do this regardless of whether we want to sell. And that's why I'm trying to say that understanding business valuations will help us make better decisions on how to invest back into the company. And I'll be walking through different ways to increase the multiple as well in this video, and then how to calculate out net debt and working capital, regardless of who owns the company. And these are good metrics for you to measure as well, not just net income and revenue. Then we can go on to the strategic transaction value. And the reason I bring this into play is because two deals, regardless, could have the same exact purchase price and wildly different deal structures. So behind every company is an ownership structure that will influence how that next company is run. Private equity is different than venture capital, is different than public companies. And each of those type of, or an ESOP, each of those types of companies have a different mandate for their cash flow needs versus their equity valuation target, and in what timeline and how fast that timeline is. Private equity, 5 to 7 years. An ESOP is in perpetuity, and a privately held company is based on their goals. So that's why we're going to clarify your goals, because you have to come up with your goals in order to actually understand the constraints of cash flow and equity. But regardless of once we have that ownership structure identified and say, okay, here's the different games that they're playing for the timelines and the cash flow and the equity targets. When a deal's done, or a transaction happens, you're going to start with this normalized EBITDA times the multiple, and then that equals this enterprise value. And that enterprise value is not how much money goes into your bank account. What we're really concerned about here is net proceeds equals money in bank after taxes, debt, and the deal structure. So you could have a $10 million company. So if the enterprise value over here was 10 million bucks, you could get that $10 million in a lot of different ways. Cash would be, if you got all cash at closing, that's a rarity, but it definitely is possible. And then there's another form where we stack on and say, okay, well, maybe you get, I'm going to make up these numbers, so bear with me. So 2, 4, 6, 8, 10. Let's just say we do 2 million in each. So you get 2 million of that 10 million at closing. Then you have another $2 million in a seller's note where you're the bank, and you have an interest rate that you're charging that seller, and it's based on the execution of the company and their ability to pay. So you have risk on the payment based on the future execution of that company or the financial stability of that buyer. Escrow is where you're putting money into, let's say it's 2 million bucks. And that escrow can be usually it's called reps and warranties, where you say, okay, the buyer is concerned about this contract actually coming to fruition, or some environmental remediation, or maybe it's an audit on the SaaS technical platform. And that 2 million bucks comes after 18 months of a promise that actually got delivered. And then an earnout is the next layer. And let's say you got another $2 million on that earnout. And that earnout is essentially a comp plan for you. So it's another way of saying we're going to give you a bonus if we hit these revenue and cash flow or EBITDA targets, and like all of that's negotiable in the deal. And then the last one is rolled equity, which you're taking a percentage of your proceeds. Let's say it's $2 million, and you're putting it into the buyer's company. And that has risk on them executing. So that way, and it comes with them having to buy your equity out, or it's another transaction. So all of these deal structures are available in almost any type of transaction in the middle market, whether it's an ESOP, private equity sale, third party sale. Each one of those different ownership structures and buyers will have a preference on which one of these tools that they use, but each one of these strategies will impact your goals. And that's why out of 460 podcasts now, the regrets that I hear from people is I wish I would have known, because I had all this, like, I no longer had control of my company. Then all of a sudden we had way too much debt on the business. Everybody got distracted. I didn't hit the strategies. I didn't get my earn out. The rolled equity was fake because the private equity firm was just, BSing the valuation of the company. There's all this risk and you have no control. So that is why we start with the owner's utility lens. Because if all of a sudden you're making that 400 grand in free cash flow and you've decoupled your time from your business and it's providing a good rate of return, why the hell would you sell your business? There are good reasons, but we want to think about them intentionally and say, okay, well, there's industry risk I want to de-risk my current situation. I want to put that money into other things. But we're starting with, hey, I don't need to sell because I've decoupled my time. I've become a capital allocator. And then what the market valuation allows us to do is to say, based on those 4 KPIs, let's say you get an out of the blue offer and you go, well, holy crap, this is a premium on, let's say it's a 50% premium compared to that market valuation. Maybe I should talk to this person because it's way above my owner's utility and the market valuation. So it might be interesting to talk to that person. And then you can look at that specific deal and say, okay, now who's the buyer? What's the ownership structure? I would say ownership and deal structure. Because what if you don't get all your money up front and all of a sudden you're now hanging your needs onto someone else's ability to execute and you're outsourcing the outcome? We want to take the most amount of control possible and say, this is what it's worth to me. This is what it's worth to any buyer. And then this is what it's worth to a specific person. These 3 lenses will allow us to then make decisions on whether we should take an out of the blue offer, whether we should reinvest in the company, whether we should take distributions, and we can get rid of that anxiety and that fear of just guessing every day. This is what I want for everybody is I want you to have independence, because that's why we start a business. And that's why we're taking all the risk. And a lot of times we have less time than we thought, but I want the time that you've invested into your company and building the business that you have to be worth it, regardless of whether you sell or not. You could scale, you could sell, you could do whatever you wanted, but you understand the implications of how it's going to impact your time commitment and your role. You're going to understand how it's going to impact your cash flow needs, and you understand how it's going to impact the equity growth and your net worth, so you can stay aligned with your goals. If those decisions are not going to get you closer to your goals, you either might need more data, you might need to expand your aperture to say, okay, well, what are the other options here that could actually get me aligned with my goals? Am I trying to solve for my time? Am I trying to solve for my cash flow or my wealth? And what's the implications of the different situations and decisions on those 3 things within my given timeline? And that's how we then balance this flywheel out, saying like every choice that we have, we're going to have to invest some time. Well, the reason we would do that without getting paid is because we're growing equity, or we can see we can see the other side to be able to generate more cash flow. But no matter what we're doing, we have to give up one of these. So if you end up hiring a CEO or executive team or putting in more systems, you're beginning to be giving up cash flow. And the goal is that you would get more wealth. But if you don't need more wealth, maybe you don't want to do that. And you don't want to sacrifice your cash flow. There is no wrong answer. It's just about understanding what you want, what the decision will do to your goals and to your ability to keep this momentum, because it's this momentum that will create options, because you're decoupling your cash flow from your time while keeping a line of sight onto your wealth, because you now understand valuations and you're using the 3 lenses in order to make decisions. And so that is why we start the framework by understanding how business valuations work And the next module will be, okay, now that I understand this, now I can actually clarify my goals. And it's interesting because, to be honest, for a long time I had these two switched. And then I realized, like, well, people actually couldn't clarify their goals because they didn't understand how valuations work. So we're trying to expand our knowledge, understand how business valuations work and how the game of ownerships works. So that way, then we can like clearly fill in our goals of time, cash flow, and wealth, be way more realistic. Because if this hand on the bottom is reality and this is expectations, it's that gap that is resentment and unhappiness and all the regrets that I hear. And we're trying to shrink that gap by increasing our knowledge and then clarifying our goals. And then the last part of the drive strategy, or of the plan phase, is drive strategy, which is creating this ownership cadence of making decisions based on our goals. And that is the end of the overview of the three lenses of business valuations. I hope this was helpful to give you an idea. I would check out the owner's utility lens first. I'm going to have a lot of detail in each of these three videos. And the goal is that you can pause, rewind, and then you can also figure out what content should you consume after that. Because you might know some of the material, some of it might be brand new for you. And the goal is that you, in your own time, without people hovering around you who need something from you, you can spend time thinking and actually clarifying your goals and actually understanding where you're headed and why.